So I'm really excited now to introduce our next session, which is a whole bunch of startup demos in FinTech, which is cool. And I'd like to hand over the stage to Evan Eisman, who's one of the founders of our MBA FinTech Club. So many of our MBA FinTech Club members are actually here milling around, working at the conference today. So I'm very grateful for them to being here and also for being so enthusiastic about FinTech in general. So Evan, take it away.
Thank you very much, Kathleen. So I'm very excited about this demo session that we're about to have for the next hour. And I'm just going to kick it off right away. So to kick off our demo session is Katya Chuprina, who is the Chief Strategy Officer of Thinknum, which is using data aggregation to get data-driven investment ideas. Using data aggregation to help investors get data-driven investment ideas through company websites. So without further ado, Katya.
Thank you. Hi, everyone. Thank you so much for having me. So question to the audience, how many of you have heard about alternative data? Okay, so decent amount. Happy to hear this. It's funny because it's second most popular topic after crypto in finance right now, so it's always good to know that people have heard about it. But let me start by telling you a little bit about myself. So I spent about a decade as institutional investor, and I got pretty familiar with all the kind of headaches, but also the opportunity that resides within big data. And so to answer the question, what is alternative data? It's actually relatively broad, and I think Wikipedia defines it as kind of run on sentence after sentence. But really, it's any sort of data that is neither fundamental, so company financial statements, nor market data. So it's anything in between, and it is truly broad. But I think the question that I would like to address today is really not what is it, but more why now. So why is alternative data really having such a big impact on in finance right now, and why institutional investors are all talking about it? And it's really a twofold question. So first of all, there is technology. So computing power has been obviously improving by big steps. So that helps. But the more interesting part is actually economic activity is moving online. And it's not just economic activity. I probably should say all activity is moving online. And if you think from company perspective, and you think from hiring, like Indeed, to companies firing the employees, like LinkedIn's probably the place where you'll see it. Then these employees go and review their companies online, which would be Glassdoor. Companies sell their products and price their products online. So Amazon, each and every one of you probably has ordered food online at some point. You order transportation online. Some of us date online. So it's really, really broad thing that's happening. And the reason why I think it's quite interesting right now is because all these companies that have moved economic activity to the internet are actually the most valuable companies. So think, the Facebooks and the Ubers. They tend to, be majority of the market value. So the data is obviously that's relied behind is extremely useful because it's real time, and it tends to be much more, less subjective to manipulation by either company managements themselves, by accounting standards. It all comes from different sources, so it's almost impossible to control everything that's out there about any given company at any given time. And the other really interesting thing is it's really becoming more and more part of the investment process, because if you think 20 years ago, 70% of company kind of stock performance, or even sometimes even fixed income like bond performance, was really driven by fundamentals. So there was kind of direct relationship. Right now this relationship decreased to maybe 15-13% last time I seen it. And at the same time you have investors who are moving from super kind of active superstar investors, especially if you think about hedge fund manager space, to a lot of really more passive kind of smart beta-driven techniques, which also have very small costs attached to them. So as investors, for those among us who are investors or even people who are looking at companies to analyze them in, for any purpose, we're really facing kind of a trade-off between, do we accumulate everything that's out there and kind of innovate our process, or do we keep on, relying on old sources, which are basically not really predictive of reality anymore and are also not timely enough. And as you can guess, my answer is probably not. I think we should innovate. Now, there is a big problem with this. All the data that's coming from this kind of third-party sources, and there are a bunch of them. It kind of, I'm just showing an example here. It's extremely unstructured. So there is a lot of stuff there that's useful, but there is also a lot of stuff there that's complete garbage, and it's really, really hard to process. And this is where the tools come in, and I think this is where machine learning comes in. If you notice, the title of my presentation was, superhuman investing before AI. I don't think we're really in the days of fully blown AI, especially in the investment world right now. I think human is still in the center, but the human can actually leverage the tools that are being built to really take advantage of the skills that are uniquely human. So, creativity, kind of contextualizing things, looking outside of the box, interpreting very complex ideas. So that's pretty much what we do. Actually, we build a platform which is largely driven by machine learning. So there is very little human input, but we scrape all sorts of web activity from the internet, and we index it, we map it, we scaled it to 400,000 companies globally right now. So it's extremely, extremely broad. It's public companies, it's private companies, and we're just trying to present it in a way that any investor can use it. So it doesn't have to be, you don't have to have programming skills. Actually, you don't have to be, very, very quantitatively driven. You can be, fundamental analyst who's just looking for extra insights. So who is kind of on the receiving side of this? We've been working with, we started mostly in hedge fund space. They were the first adopters. Right now, we cover probably 20 asset managers, hedge funds, and long onlys. And we work with top 8 out of 10 bulge bracket banks. So the adoption has been there. It's been there. It's been for a couple of years. There's a lot of sell-side research published with, web scrape data specifically, but also broader alternative data. And, without further ado, I actually just wanted to show you a couple of examples of what it actually looks like. So one of the companies, okay, let's hope this clicks. Apparently not. So one of the companies that has been in the news a lot recently is Sears. I cannot speak for the fate of Sears. I think it's been kind of sealed by now, unfortunately. But we can take a look at other companies. We can take a look at their footprint, and then we can take a look at the companies that are still publicly traded, that are actually going to have some sort of impact, probably very large impact on them from Sears going bankrupt. So I'm opening here. This is in real life, and this is store locations from Sears website in real time. So we usually scrape data daily, so we have time series for stores. Sometimes it's a little bit less often. But so what you see popping up here is both Sears location and Kmart, because Sears owns Kmart. The machine. This is part of the machine learning beauty of this. If a company owns 10 subs, they're actually going to show up. So they're going to show you all the relevant information. So if you want to look at kind of like the data schema for something like this, just quickly load this. You will notice one thing. So, for every single Sears, it can tell you exact location where it is. Everything is broken down and kind of indexed in a smart way. But then you end up having also geocoordinates. So geocoordinates is something that allows you to see how this is located versus how the stores are located versus other competitors. So in this case, let me just put a simple example. So JCPenney into this. So you'll see how JCPenney overlays with Sears. Okay, so it's a super messy map, but as you can imagine, because there are geocoordinates attached to both, and they're both scraped in real time, you can kind of see who if they're close, if they're not close. We do have a lot of analysis that has to do with overlap, so how many JCPenney are within 1 mile. I ran a script with I think it's like 12 or 13 closest competitors. And I'll just load them here. So we'll see which companies that are competitors of Sears are basically the most, just do this one, which ones are the most affected by Sears closing. So turns out Walmart Superstore is the one that has the most 131 stores that are within, closest distance to Sears, however we define closest distance. I think it was like 1 mile here, followed by JCPenney, Best Buy, et cetera, et cetera, et cetera. As an investor, you obviously know how to interpret this information. And this is where a kind of human factor in decision-making comes in. Is it better for all these other competitors that somebody like Sears went out of business, or does it decrease foot traffic? Sears was anchor tenant in most cases. So does this mean that the REITs that have all these other stores in them are going to be affected in a positive or negative way? So there are all those questions that we're not trying to answer, but we're at least giving you the tool to realistically look at this and be like, okay, this is who affected and this who is not. So lastly, on Sears, obviously it's going to affect the labor cost quite a bit in the areas where Sears is located. And we do have job postings for Sears, which don't exist anymore, basically. But there is another company that has been doing quite a bit in terms of controlling their costs through jobs. So they tend to manipulate their cost basis almost on a daily basis. And it's going to be Tesla. So let me pull up this example quickly. So this was actually a real-life example where a lot of investors took advantage of it, but also a lot of investors weren't really happy to see this. So when we pull up job listings for Tesla, we capture them every day. So every single day you see, how many positions there are, what those positions are. You can kind of word search for individual titles here. You can tell where the positions are, all that information. But the more interesting part is actually just looking at it in chart view. I guess give it a second. Okay. So do you see this big drop right here, starting like end of May, beginning of June? So on June 6th, we published an article saying that Tesla caught close to 1,000 jobs at that job postings at that time. And a lot of investors, who are our clients and also who just saw the article, they came back to us and they're like, there is no way, they haven't announced anything, is this even real data? I'm like, well, we get it directly from Tesla website. So turns out that on June 12th, Tesla actually announced their restructuring plans. You had 6 days, 5 to 6 days, to take advantage of something that was clearly happening before there was actually any sort of statement by the management team. So, very clearly a very predictive case, and the data is from Tesla website. We're not backfilling or coming up with anything here. It's literally what we see there every day. I'll show you another example. So for Tesla, very interesting trend right now is going to be in their charging stations. So that's something that's been driving automotive and also utility industry in the US is expansion of electric vehicles. So those electric vehicles need to have charging stations. Tesla has its own networks. There are a bunch of other utility companies that are building out their networks, but the sell side kind of approved number is 30% growth per year for charging stations. So I'll quickly show you where Tesla has its charging stations. It's going to be a very, very busy map. So as you can tell here, it's going to be both Tesla Motor Stores, which we'll get rid of, Tesla Motor Services. So right now we're just looking at chargers. And we can figure out where they've been adding chargers. You can filter for chargers added in the last week, months, whatever. But the interesting part is actually, again, here in chart view. So you'll see that the number in this year, 2018 onwards, we're up about 30%, so that's kind of in line. But when the initial estimates by sell side came out in 2017 of 30% growth, Tesla went from kind of 4,500 charging stations to 10. So that's more than doubling. So they are actually way, way ahead of the game in terms of building their public network. Their private network is obviously growing on top of this. So just taking a quick change from, so we capture about 30 different metrics for those 400,000 companies. Many of them are kind of related to jobs and employment. Many of them are related to pricing, but it's always like from company kind of up. So it's really bottom-up research. We can apply the same process to look at things top-down. And it's a separate tool, but it's using exactly the same information. So when you go to Screener, we can take every company that's in our database, which again, 400,000 right now, but constantly growing. Public, private, doesn't matter. And we can start adding screening metrics on which we want to judge those companies. So an interesting one would be, let's say, employees change months over months. So, sorry, 1 second. So the question that you want to answer is which company is growing the fastest? And you probably want to narrow this down to companies of certain size, right? Because company of 3 people can grow by a few thousand% easily. So let's include current employee count. And let's actually add the filter. So let's say tech sector. So you can choose any sector, any market, any country, anything you want. But let's start with tech since we are kind of in fintech here. So it's always fun to look at. So you're looking at companies that let's say have from 500 to 500,000 employees. So mid to large caps in tech sector. And you can very quickly see which of these companies have actually hired the most people by percentage in the last month. And this information comes from LinkedIn. So LinkedIn reports the number of employees for every company every single day. It's self-reporting, but it's very, it's highly, highly correlated with what companies actually report. So let's say that within this, within this space, we actually want to figure out which of those companies have the best rated management. So let's look at CEO rating. I love my autocorrect. So let's look at the CEO rating for the same list of companies. And see who's the highest rated. So CEO rating has improved for Diodes. No idea what this company does, but it's in tech and it's listed on NASDAQ apparently. So this is whose CEO rating has improved the most in the last months. Of course, the more interesting question is whose CEO rating fell the most. Sometimes improvement, they reset CEO rating every time there is new CEO, they reset it to 100. So here actually the worst performing CEOs, according to Glassdoor, which has been academically reviewed quite a bit actually. So these are the companies with the worst performing CEOs. United Microelectronics, Evernote. I'm actually surprised about this one. But again, this is daily information. And if you really want to dig into it, you will actually end up doing something like this. You will go, you'll go into this number, and you'll see where it's coming from. And you'll not only see all the reviews on Glassdoor that's relevant to this company, but you'll see, sometimes you see the text of, of the reviewers. So there's really a lot of information. I think the only thing that I kind of want to leave you with here is, keep kind of alternative data as part of the big picture. It's just one of the tools that's supplemental to the investment process, but extracting insights from this type of data, which is very big, very unstructured, is only possible with tools. And accumulating this data by itself, it's not really valuable. So you want to get insights. You don't really want to, you don't want to limit yourself to like, okay, I'm just sitting on a pile of information which I have no idea what to do with. So right now, I think AI is still not there necessarily. But as far as investment process goes, I think we do have the tools, and these tools are being used by, some of the most successful investors. Thank you.
Thank you. Yeah, so you're next up. Okay, good. Yeah, perfect.
Thank you so much, Katya. So up next is Uday Akkaraju, who is the founder and CEO of Bond.ai, a company that is working on human-centered AI and making machine learning more empathetic. So without further ado, Uday.
Hey, very good morning, everyone. I am Uday Akkaraju. I'm a human-centered designer and the CEO of a company called Bond.ai. So we call ourselves human-centered design, human-centered AI because we focus more on the user than, of course, AI, but we focus more on how do we calibrate more information from the user and then translate into a very human-centered, empathetic AI. So, this conference, is thanks for inviting me. This conference is very kind of special for me because it's more about entrepreneurship, it's more about data science and fintech, and those three things have actually played a very important role in my journey so far. So I thought I should just share my learnings, my experiences, along with my demo about all these three during this next 15 minutes. So I'll start with what happened and how, I'll share how I got into entrepreneurship, how I started using data, then how we built a platform that is disrupting the financial world today. So a couple of years ago, not long ago, it just feels like yesterday, I was in a tremendous financial stress. So do you know how many people actually are in financial stress today in the US? Any guesses, percentage?
20.
What's that? 20%? You're way off. It's 85%. so it's predicted to get even worse in the next coming few years. So I was one of them. So my finances were in a disarray. I had bad credit scores, a big student loan sitting on top of my head, big mortgage, car loan, you name it, everything was just so bad. So I had to do something to get myself out of it. So I started, like everybody, started using apps like Mint, one thing for savings, one thing for investments, one thing for canceling my subscriptions. I started using like 18 different apps, different platforms. But 6 months down the line, I realized nothing was working, nothing was adding up. So what I realized there was, I think everything needs to be done holistically. Everything needs to add up together. You cannot do one thing for saving, you cannot do one thing for investing, you cannot do things separately. You have to do everything together. And I thought, okay, I should design a program for myself. Then actually I started looking at data, and that's the first time I actually started looking at my own transactions, not only my financial transactions, but also looking at other data of mine. So I actually created a model. I created a small program, and 18 months down the line, it worked. I successfully came out of it, and I also had some money to invest in my company. So that was the kind of inspiration for me to actually create this platform. And what we call this is, using all this data, using all this experience, we created the world's first empathy engine for finance. And we are using that empathy engine to banks. We are powering their mobile apps, we're powering their internet banking, we're powering their voice banking, and even their back office. So we are powering this empathy engine, which is the AI, which is actually the empathy engine powers all the AI so that banks can actually solve these problems for their consumers. Because when I was in a problem, I went to my bank, they didn't have any tools. And the first thing people do is go to their banks, and we are providing all this end-to-end empathetic AI platform for banks. If you see companies like Amazon, Netflix, Google, they're using data to satisfy these consumer expectations, and they're generating billions in revenue. And when it comes to the most important thing in our lives, money, banks are not using. They are sitting on top of the most valuable data set on the planet, and still today not even like 94% of the banks aren't able to provide the same experience as Uber or Amazon is providing in the financial world. So we created a platform. Let me show you a demo. It works with everything, but today I'm going to show you with how it works with voice. So I have an Alexa here. So I'm just going to try doing something with this because the internet is not stable. So let me try to. So if you see, any kind of financial question about yourself. So this is connected to my bank account. So, and I can ask any kind of questions, and let's see what it will do. So I can simply ask simple questions like, what's my balance? And you'll still see a difference what the empathy engine actually does to those kind of questions. Alexa, ask Bond, what's my balance?
You have $13,240.90 in your checking account. I forecast you can save $550 this month. Think you can beat that?
See, it not only gives me a straightforward answer, but it kind of gives me a behavioral insight. Okay, I can save this much. Do you want to do it? If I say I want to do it, it'll actually help me do it. So those insights are very key. And let's take another cliched example and ask Alexa, ask Bond how much I spent at Whole Foods last month.
You spent $80.60 at Whole Foods last month. It is $21.07 less than your monthly average.
Again, that behavioral insight. So this is very important. So those kind of small behavioral insights nudge a consumer towards incremental behavioral change. Education doesn't work. PFMs never work. The only thing works is behavioral change, and that can be done incrementally by these small nudges. So what we do is we take all the anonymized data from a bank, credit and transactions, credit card info, account info, loan and mortgage, everything. So we take all the anonymized data and look for deep behavioral attributes, spending patterns, habit patterns, and 42 more data points, and we create a unique persona for every user of a financial institution. And then, according to that persona, the empathy engine acts accordingly. So these insights are unique to every user. It's different for me, it can be different for you. So it depends on the context, it depends on the persona. And so this is one-to-one personalization done for user at scale for the financial institution automatically and continuously. So let's take an even more complicated example and ask, Alexa, ask Bond if I'm using the right credit cards.
Let me see. Looking at your spending pattern, your current credit cards do not seem to be the right fit. Shall I suggest you suitable cards for your profile?
Sure.
Great. The best combination of credit cards for you would be a Capital One Rewards card for your frequent travels, and your Bond Bank's Platinum card for best cashback on your daily spending. Would you like to replace your credit cards with this new combination?
No.
Okay. When you want to apply, let me know. Hey, by the way, you seem to travel quite a bit. What's your favorite airline?
Delta.
Fantastic. Talk soon.
I mean, you see that, right? See, it doesn't feel like AI, right? So, but it is actually. So the thing is, it not only crunches data in a human-centered way, but it also kind of extracts non-financial data contextually so that it can understand a user holistically. So it is very important that only financial data doesn't matter. It's just 50% or even 45% of the consumer's profile. So the non-financial data is very important. That is what it calibrates. And if I actually say I want a credit card, it can actually connect to the fulfillment system of a bank and then process it. So even visually, I can show you a demo. When, when it is connected to a mobile dashboard, this empathy engine, what it does is actually it gives you, if you connect your mobile dashboards of your bank today, what do you see? Just balance. What is it doing for you? Nothing. So what it does, the empathy engine, as soon as you connect to your bank account, it shows you your whole financial portfolio. Okay, what's there? What's wrong with your portfolio? What needs to be done? If you see here, I mean, all good here. My student loan is fine. I can refinance it in 14 months. Those kinds of insights are very important. And the bubbles in red are very important. So if you click the one in red, it shows you what's wrong with your credit cards, and you can what do you do to fix it. And not only it shows you what to do, but also gives you indications in a social context that what your savings might be. And it also gives you average, okay, average people in your kind of profile, user group, age group are saving this much, you can actually do much better. It can show you about investing, subscriptions, and even things like it not only helps you optimize your finances, but it also tells you how to maximize your finances. Like here, it actually tells me that I'm all equipped to buy a house. So as soon as the user sees it, what happens? I mean, it's all about the instant gratification behavior, right? They want to do it right there. And a financial institution needs to capture that right then. So what we facilitate through the platform is the user can immediately chat, okay, I want to buy a house or something like that. Or he or she can even ask, Alexa, ask Bond, I wish to buy a house.
Great. Have you finalized the house you want to buy?
Yes.
Well done. I see this is your first house. Is that right?
Yep.
Wonderful. Where is this house located?
Boston.
And what is the value of this house?
$300,000.
Okay, awesome. Do you have a co-applicant for buying this house?
No.
That's fine. Hey, by the way, I see you have $17,511 in your savings account. Do you wish to use this amount for the house goal?
Sure.
Okay, let me analyze. Bravo! You are pre-qualified, and I can help you get 20% down payment in 17 months with the best mortgage offer ever. So ready to start saving for your new house?
Let's do it.
Awesome. In the next 17 months, I will help you save, optimize your expenses, and invest to meet your goal. Let us rock.
That's it. And you name it. I mean, it can do your refinances. It can do anything you want on your financial side. It'll help you do it. So the empathy engine is not only for the consumers, but what we also do is also power the back office of a bank with this intelligent data. So what we do is we identify consumers according to their behaviors. So for example, if you see the green zone, this is a zone with users with the most stable behaviors in context to all of their needs, like student loans, deposits, and stuff like that. And this is a zone with users with less stable behaviors, and the red zone with users with irrational behaviors, like I was before. So the most important thing for the bank is the green zone, right? So for them, this is the holy grail. So they see people, they see empathy clusters here. They can easily, target them for the existing needs which we identify. They can simply say, hey, student loan, they get that, or even deposits. So they can actually identify, we have identified people according to needs. They can just target them, and they'll see a more high conversion rate, because we've been seeing conversions of like 60%, 80%. So because the thing is, we've already identified them and they are stable. But what importantly we do at the back is users in the other two zones are very important, right, for the bank, because those are majority. So what the empathy engine does for the bank at the back is incrementally nudges them towards the green zone so that users are financially stable over a period of time, and the bank is able to make money out of it because users are stable. So we are working with a lot of financial institutions here in Europe and in the US, and we are seeing significant stats because of this, like 200% increase in the lifetime customer value, 12x increase in the loan to deposit ratio, 65% increase in marketing efficiency. So these are huge stats which the banks or financial institutions haven't seen before. So, and for making it so easy for them, we have actually plugged into core banking providers, mobile banking providers, so that for the financial institution, it becomes as easy as plug and play. So I always say, hyper-personalization is the future of the financial industry and the financial world. And Bond.ai is a full-stack platform that will power consumers, their back office, and also help banks monetize the whole phenomenon. So that's about our platform. But I think because this is a conference, I told you it's for entrepreneurship, fintech, and data science, I thought I should share what we learned so far, and maybe that might be useful for people here. So when I tell about fintech, so what we learned so far is the only thing changing faster than technology is consumer expectations, right? So if you have to satisfy those consumer expectations, you have to transform from being a product-centric mindset to a customer-centric mindset for any fintech or a financial institution. Coming to data, today with data, you can do transformational things. You can do a lot of innovative things, but empathy is the greatest source of our innovation. And unless you cannot empathize unless you have both sides of data, intangible and tangible. So as a data scientist, you have to make sure you're considering enough data points to create your model. Otherwise, it's going to be a failure. And as an entrepreneur, finally, when I actually started picking myself out of the hole, I didn't have another plan. I didn't have another option, right? So as an entrepreneur, if you really want to change the world, you cannot have a plan B. You cannot settle for anything less. So you either succeed or fail utterly, and there can be nothing in between. Thanks.
Thank you very much, Uday. So next up is Laura Kornhauser, who is the president and COO of Stratify, which is a company that provides prescriptive analytics solutions to banks and insurance companies for more accurate risk assessment and insightful decision-making. Welcome.
Awesome. Howdy, everyone. How's everybody doing this morning, almost afternoon? Only 2 more sessions before lunch, so don't worry, it's coming soon. But thank you all for being here, and thank you so much to NYU, to Stern, to the FinTech Association for having us here. I'm so excited to tell you about what we're building at Stratify. I'm going to walk through a little bit about who we are, then, of course, the problems we're focused on solving, and then we'll get into a shortened live demo of our product to show you exactly how we do all of the wonderful things that we do. Hopefully we'll have some time for Q&A at some point towards the end, and if not, find me during the lunchtime. Happy to answer any questions you have. So this is a quick snapshot of our founding team. My personal background, I spent over a decade working at JP Morgan in various risk management fields, helping both corporates and institutional clients build structure and deploy risk management structures. As I'm sure many folks in this audience can understand, I experienced a lot of the problems working with some of the heritage technology solutions that Stratify is out to improve and to better empower the experts. I'm joined by 3 extraordinarily talented and intelligent folks, and the group of us brings over 50 years of finance and technology experience to the co-founding team of Stratify. So what are we here to do? At Stratify, we look to bring AI together with IQ to provide a predictive analytics and decision management solution to banks and insurance companies to enable more accurate risk assessment and ultimately more informed and better decisions. Our proprietary technology that's at the core of our platform brings the accuracy of an AI-based approach or machine learning-based approach to advanced AI, but also offers full transparency into exactly how and why we arrived at every individual prediction and decision made on our platform. This enables, we believe, this technology to be utilized around some of the core applications where AI and machine learning haven't made as much traction within financial services. So we'll start up talking about the problem from the customer side. Customer profiles are changing rapidly. And the traditional ways that we used to measure the riskiness of a given customer just don't work anymore. Immigrants often come into this country with very, very wonderful credit, yet they don't have the credit history to have a FICO score or have a good FICO score. 90% of the lending decisions in the United States are based on primarily FICO score alone, and this population is just knocked out without even getting a chance. Millennials have an average FICO score of 617. Most bank lending models have sharp cutoffs, anywhere between 620 and 680, that just, again, dump out this huge portion of the population that is increasingly important to financial institutions. And then there are all alternative work arrangements, such as the one I currently have myself, which recently had me rejected for a credit card by my former employer, Chase. Very nice. After they tried to probably spend, I don't even know how much money getting me to apply for said credit card, which is another issue. Anywho, financial institutions need a better approach. They need a better tool. It's not as if financial institutions want to be saying no to all these borrowers. It's not as if they want to be making these kinds of decisions, but fundamentally they're armed with the wrong tools to really accurately describe a world that looks very different than it did when a lot of these tools were first developed. Customers changing is not the only problem or pain that financial institutions are facing. Competition's coming from all sorts of angles. They need to be faster, better, smarter to compete in a world where their lunch is at least trying to be eaten every day by emerging companies coming up with new interesting business models. So they're left, okay, what tool do I use to evaluate these borrowers in this changing world? Do I stick with the expert-based systems, scorecard, rule engines that I've grown accustomed to using for years and years and that have the transparency I need? Or do I use machine learning or AI to better predict these complex outcomes? We believe that neither alone is sufficient, and the right approach is one that takes the best of both worlds, blends them together in one unified solution for predictive analytics and decision management. If we looked at these existing tools on an axis of complexity, it's not as if they're not really great for certain challenges. Business rules or other expert systems are great at managing access into a building. I swipe a badge, it says if I'm still part of a workforce. If so, lets me in. On the other end of the complexity spectrum, we have AI, riding in like a knight on a white horse, solving everybody's problems just with the click of a button, right? Very good for complex challenges like face recognition or winning Jeopardy. But what about all these challenges in between that are really core to financial institutions' businesses? Risk assessment, decision analytics, model validation, fraud detection. While both tools are kind of trying to blend towards the middle to solve these problems, we believe neither is doing well. Not surprisingly, the business rules are too primitive for your data scientists, while your compliance officer says, no way are you going to use machine learning for credit risk assessment here. Stratify comes in to solve these very important use cases at the center by, again, bringing the best of both approaches together in one unified solution. If we look at existing technologies on an axis of transparency versus accuracy, Most technologies out there, as you get more accuracy, you do so at the sacrifice of transparency. We believe financial institutions need to be above this transparency threshold, again, for these core use cases that I just mentioned, risk assessment, et cetera. Stratify, like every startup, we have to have some slide when we're in the upper right. Stratify's right there, offering you the accuracy of your most advanced AI-based approaches, but with the full transparency of an expert system and a business rule engine that, one, not only your people are comfortable with and used to using, but also past your internal compliance needs and is satisfying to the external regulators. Now, these are not just things we claim and things we say we can do. Our AI meets IQ drives real-world results. These are results we achieved with one of our customers. We were able to achieve accuracy in line with a neural network, but with, of course, all these added benefits of transparency into exactly how and why the decision is made. And also, maybe most importantly, how you as an expert can impart your expertise onto that decision. Your years and years of experience, your institutional knowledge, the risk appetite and tolerance of your institution, how you can fuse that together with the additional insights in your data. So we can work from any starting point to get to the perfect initial model. Very easy to initiate. We can either have customers start with data start with a model, and we effectively look to that model and then find additional valuable rules to add to that model and combine them seamlessly. Or we can just start and do a cold start from data only, and we build a fully transparent but machine learning enabled model from a known data set, so a data set where you have known outcomes. We'll get into this a little bit more specifically when we switch over to the demo. So a little bit about us. We started the company about 2 years ago when I was in my second year at a business school, also in New York City, but I won't mention the name. And when we started on day one, we had over 10 years of R&D into our core engine by one of our co-founders, Dimitri, who has a PhD in theoretical physics and was working in risk management and finance and spent a lot of his I'll say very high level of brain power and his expensive man hours working with these heritage expert systems and kind of trying to bring them up to snuff, set out to find a better way and started working on our core engine. We had pre-seed financing about a year ago that enabled our product launch at Finovate this past spring. And we're striking initial paid partnerships right now and going out for an institutional round towards the end of this year, beginning of next year. We've been featured in some notable press, we believe. Look out for us on PBS coming up over the next year. We're their chosen FinTech innovator, and then we're part of a number of amazing communities that have helped us both build our business and get out and see customers. So we'll skip through this really quickly so we can get to a bit of a demo. So what I'm going to walk you through right here is how we use our platform on Lending Club data to both start with the initial model that a customer would be using. This is a representation of that right now. On the left-hand side, you have all the variables that are in play. On the right-hand side, you have all of these rules that a customer may be deploying via a rule engine or scorecard or other expert-based systems. The first piece that our increased accuracy comes in on is in this confidence level right here. These confidence levels are calculated by our engine automatically using a machine learning-based approach, and they can be calibrated to any data set that you have. So this is calibrated right here to this data set that I've preloaded right now, but if we clicked there, this would normally be calibrating these rules, making these rules ultimately flexible, such that no one rule is actually deterministic of this outcome. Meaning, let's say I have a rule in my current engine right now that says 680 or below FICO score. Absolutely not. Why should a 679 be so different than a 681? We believe it should not be. So what our engine allows you to do is still take that as an input and still use it to potentially bring down an overall score. But the ultimate decision is much more of a tug of war between all these inputs as opposed to one input immediately knocking you out. Should you have rigid risk tolerance, you can, of course, impart that as well, and then lock that rule to make it rigid. We can put kind of the bounds that you may need around this engine as well very easily, and then calibrate all those rules freely. This next piece that I'm going to show you is how we bring in a model that has the additional rules that we've mined from historical data. This process is currently done offline, requires some data science work on our side, but most of it is automated. And then we can bring these rules in and again calibrate them, figure out the combination of confidence levels that makes these rules then most accurately describe the data that we just loaded in. Now, again, I talked a little bit about your ability for an expert to impart their own views of the future and how it might be different from past into the model. This is one place you can do it. I trained on data, but we all know data is only as good as the history, right? It's by nature backward looking. So you can come in here and also say, okay, I understand why you learned this from the data, but I think this is going to be more or less important going forward, and make those changes as easily as that. Adding a rule is as simple as a few clicks. Deleting a rule is easily as simple. Just come up here, click it, and delete that bad boy. Currently, those processes, depending on the complexity of a model, can take days, weeks, or months by financial institutions. Then we can move over real quick and show how we take these models forward and make sure that they meet our business objectives. Here we have the new model with the mine rules added in here. And then we bring in a historic data set and see, okay, how would that model perform on that data set? Let's say that business has been a little slow lately, and we want to try to underwrite some additional loans. I can update my business goals as easily as you just saw there. That's a fully customizable widget, if you will, based on customers. See exactly how those results impacted my overall performance. And then go and, again, drill down deeper. See, okay, what if I change this rule? What if I change this rule? Recalculate. And I'll see exactly how that ultimately impacted my overall performance on this data set. We have some great features on backtesting and model gallery that we won't go through right now because we're running out of time. But real quick, something I think is quite cool on the execution front. Now, you can execute via our platform, though most folks use our platform to build and test models and then ultimately connect via our API for real-time execution. But one very great feature, because again, we understand exactly how we arrived at each individual prediction, we can also tell you, and decision, we can also tell you how to arrive at a different place. So in this case, for Bob 001, the answer was no. But then we can see again for Bob 001 exactly why that answer was no. And then we can see here it shows 5 different ways that Bob can get from a no to a yes. You as the bank or lender decide here whether or not you want to expose that to the customer. Maybe you use it to develop new products, or maybe you use it to tell the customer a heck of a lot better answer than just no. So with that, we're at time, but thank you so much for your attention, especially just before lunch. Lovely. Thank you so much, everyone.
Thank you, Laura. And last but not least is Michael Sanford, who is Senior Vice President of Dream Forward, a company seeking to increase access to 401k and 403b retirement plans and help participants save more for their future. Welcome, Michael.
Good morning. Thank you for being here. Just to give you a brief overview about Dream Forward has been building AI chat boxes for retirement programs since 2015. We first started with 2 specific programs, 403Bs and 401Ks for small businesses and non-for-profits. We also have our AI licensed retirement-focused enterprise to financial institutions. And we'll get into a lot of details about this, but I won't give you a lot of facts and circumstances and a lot of I've been in the industry for 25 years. I've worked for several financial institutions, both on the corporate side, but also on the technology side in the retirement arena with that. And just to give you, why did we start Dream Forward? And just think about that, is that retirement now is a hot issue that affects everybody in this room. And that when you look at it, people are not saving enough, they don't understand the retirement and what's going on in the retirement industry. So what we did is that we started looking at it several years ago when I was a consultant looking at the robo-advisors and looking at the robo-products. So we started seeing that everybody was developing the same type of product and program for that. So we started looking at it at a different way, is that, and using a hockey analogy, but I don't play hockey, is that instead of skating where the puck is, skate where it's going. So we started looking at this where we see that the retirement is going to be going in 3 to 5 years from now. So what we did is that we built this technology program working with to help support financial advisors. Now, there's a big misconception on artificial intelligence that it's to remove the human touch, the human element from that. Not with our program. We're here to enhance that, working with financial advisors, human resources departments, and also the participants themselves in a retirement program. So just to give you a look at this, a retirement overview, and look at this, is that most of the questions that we get, the retirement industry is the most regulated industry out there. We're ERISA, it's Employee Retirement Income Security Act, Department of Labor, IRS. So there's a lot of confusing jargon and technology that is out there for the program. So what we did is that, well, just give you a basic graph right there about some of the questions that we get: financial planning, tax questions, 401k basics, jargon, and investment-related questions. And just to give you kind of what our proprietary, this is what it looks like. We have it on a chat box where you can put it on your cell phone. It can be on an interface on a computer. But we cover over 300 topics in the retirement industry. And what I was saying earlier is that the retirement industry has a lot of technical jargons to it, and I'll give you an example of that as we go through this. And just to give you, this is like the chat boxes there on the right, is that you look at this and say, for example, we have a lot of times the participants and financial advisors, when they go into the retirement program, they'll say they'll want to reduce their tax savings. So this is kind of an emotional type of advisor, not so much to give them an example of what they're doing. It's like, so say for an example, the participant goes in and says, I want to reduce my savings rate. So the chat box will pop up and say, hey, let's think about it. Why do you want to do that? So we, tells them most experts recommend you save anywhere from 10 to 15%. So a lot of the jargon, a lot of the answers that we'll get from this is that why Americans are putting off savings. And we get all kinds of questions on the AI, and it's geared to answer these questions. For example, it says, I have to put 2 kids through college. And then it'll come back to this and it'll say, think of it this way. Your children can always get student loans. No one's going to give you a loan 20, 30 years from now, and the biggest burden you can be is being for your children to have to support you during retirement. So as I said earlier, the retirement industry has a lot of jargon associated with it. So we get a lot of questions that come from different, that people don't understand it. The average participant doesn't understand a lot of the technology, beneficiary, emerging market, that type. And so we get a lot of questions like, hey, what happens if I get hit by a bus? So the AI will go to them and say, hey, we noticed you were talking about, it'll give them about their beneficiary and what they can do with it. So a lot of it, we have to customize the AI for each individual program that we work with, because there's different aspects of different retirement programs. There's different matching contributions, loans, hardship, service withdrawals. So we have to be able to gear the AI specifically towards each program that we work with. And just to give this, fixing the 401k transition, as I said earlier, the retirement industry affects everybody in this room. And what has happened, there's been a transition over the years, is that it's gone from a DB focus to a defined contribution. Today, 401k is the #1 saving retirement program out there. If any of you have a DB and a defined contribution and a pension plan program, you're very lucky, because you don't do that. So we've gone this and be kind of disruptors in the industry and kind of helping shape how the way we see the retirement plan industry going for that, and using the AI information. So I was very brief on this. No one likes long presentations. I know we're all eager to get out and have some lunch, but I'll be out there on the panel to answer any of your questions about that. And again, thank you for allowing me to speak with you.